We want to talk more about the Fed. Joining us now is Jack McIntyre, CFA and fixed income portfolio manager with Brandywine Global. So, Jack, what do you make of just the reaction we're seeing, first of all, with stocks right now? Because we've seen a lot of whipsawing, and for the moment, all three major indices very much in the red after that emergency cut.
So you're right. I mean, I think yesterday's rally in equities, really strong rally, kind of was already anticipation of the Fed doing something. I mean, getting the timing right, realizing that, hey, it was going to happen today. Nobody knew that for sure other than the Fed. But the market's kind of telling us that it needs something more than monetary policy to impact this exogenous virus that we don't know ultimately how it's going to influence the real economy. I mean, the Fed was in a tough spot. I mean, the market was demanding the Fed cut rates, and they had to do it. Even with the realization, this is not the best tool to sort of fight this virus and the hit that consumer confidence is going to have as a result.
So, Jack, why did they have to do it? I mean, I'm kind of struggling with this, right? Because if, even as Jay Powell himself said, this is really, in some ways out of our hands at this point, it's up to the healthcare workers in this country. Why did the Fed need to move? Is the Fed at this point at the mercy of the market? And if so, what kind of precedent does that set for us going forward?
So, yeah, it's a great question. So why did the Fed feel like they had to move? Well, you've seen a significant tightening of financial conditions by the pretty significant sell-off in equities that we've experienced in a relatively short period of time. There's so much wealth tied up in U.S. equities that when it sells off to the degree that it does, that just retrenches the consumer. So the Fed felt forced to do something. Again, the market already expected this to happen, and the market's already pricing in more. So the Fed was in a kind of a no-win situation. If they didn't react, then equities were going to come under more pressure. They reacted, and the Fed or the market saying, hey, we need more.
I don't think so. I think if the Fed had done nothing, we would have been just fine today. I think they sent a signal of nervousness and effectively and correctly said, we don't know what's going to happen. To your point earlier, you said they need something else. The market needs something else. But what? Mm-hmm. We're not going to get fiscal stimulus. We've got such a divided country, Congress and election year. We're not going to get fiscal stimulus. So we've got to come up with a cure, and we know that that's a long way away. Mm. I mean, what do you do?
And you're right. I'm not going to push back on your scenario because you're right. I mean, nobody knows how the COVID-19 is going to play out. I mean, it's going to be time. I mean, I think we have to look to sort of what's going on in China as a potential sort of path that, hey, this is going to be a very bad flu, but we know markets are reaction to fear and greed, and we've gone from a greed a couple of months ago to fear. So so if the Fed didn't do anything, I think the Treasury yields would have come down even more so than that they're doing today, and that would have spooked even equity markets more.
All right, that is Jack McIntyre with Brandywine. Jack, thanks for joining us to talk Fed.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.